Good morning, traders. It is Wednesday, July 16th. Taking a look at the charts, we have a little bit of the opposite of yesterday. Yesterday it was the small caps down the most. The large cap like NASDAQ, tech heavy, was positive. Huge extreme yesterday. In fact, we had panic selling on our short-term panic selling indicator closing at 3, telling us the market actually got a little oversold yesterday. Most people dumped small caps. If we take a look at the Russell 2000, let's take a look at the Russell 2000 daily chart. You can see here, pretty big down day yesterday. It was down about 1.5%, I think. What was also interesting is not only people were dumping the small caps, but they were also dumping dividend stocks. The dividend sector, I think, down the most yesterday. People were getting nervous and dumping, expecting this market to roll over and go lower, which I do believe will eventually happen in a big way. But again, let the market tell us when that is going to happen. We just follow suit. Definitely saw a bout of selling. So some distribution selling was pretty high volume yesterday. Usually you have higher volume on down days. The market naturally wants to go up. That's why light volume days favor higher pricing. When we go into holiday weekends, we usually see the big money have already repositioned and they go away on holidays early. And of course, it takes volume. There's naturally money flowing into the stock market when we're in a upward trend in a bullish environment. So if light volume usually drifts the market higher, to drive the markets down, you have to have more selling than the positive inflow volume. So you need more volume in order for down days. And we saw that yesterday in general, maybe not so much on this particular ETF, but we did see a little bit of elevated volume on the S&P 500, the NASDAQ, the Russell, all of those indices, telling us that there was definitely some selling. Now, if we zoom out a little bit here, let's look at the 30-minute chart. I mentioned yesterday or the day before how we keep getting up into these, really just up into this upper range. The market gaps up, it gets up into this range, it gets hammered down. It gaps higher, gets sold off, grinds its way up, and then gets hammered down. It keeps having these bouts, had a gap down and then kind of drifted higher. Yesterday, it gapped up higher and then sold off through the entire session, selling down near the low, which is somewhat of a short-term bearish candle. It is a bearish engulfing candle, meaning it opened higher than the previous days and closed down near the low. That is not a good sign. And of course, we had some panic selling there. Now, if we take a look at the NASDAQ, it's a little bit different. In the grand scheme of things, it has been doing a similar type of thing. It moves up, it gets sold off. It moves up, it gets sold off. It just keeps having these bouts of selling taking place. Yesterday, it gapped higher and then sold down to fill that gap. As we know, gaps tend to get filled. It is holding up at a much higher level, so we'll see how it unfolds. But you can see on the bottom on the daily chart here, a lot of these red bars tend to be higher volume days, meaning there is distribution going on. And yesterday was a higher volume day. We've had a few in the last week and a half. And really, that's institutions doing these big sell-offs. There's a lot of volume traded at the open and the close. That is where the institutions, when there's liquidity in the market, that's when they dump. So the market opens up and there's lots of volume. They can sell a huge chunk of their portfolio really quickly in the morning and then stop selling. And they don't want to hurt the market. They just want to unload chunks. And so they'll do that over and over again. You know, one day it could be one institution or a couple institutions. The next one, it could be another one or a few other ones. And so they all take their turn rotating out and they all have their own strategies. So they're always going to be doing it on different days. But that's kind of what we are, I believe we're still in. Short-term wise, when we look at the market, we actually have some panic selling yesterday. The market gapped higher and faded down. You can see this still. The overall trend is still up. But when we look at this chart pattern here, we've had a move up and now it's formed a bull flag. It has come down to more or less fill the gap. So the market could very easily hook up and want to go higher today. As I've talked about over the last really week or two, saying, hey, once we hit this 15% target, this is naturally a level where the stock indices tend to get into a more volatile market, meaning we could start to see some big pops and drops in a more significant kind of percentage swings. Volatility should pick up, and generally we see the market go into a multi-week correction. It might only pull back 3 or 5%, but it might trade sideways for a while. And so that's kind of where we're at right now. And this is what I was trying to explain yesterday is when the stock index like the QQQ hits 15%, expect volatility sideways or lower pricing. Most of that move is most likely done before there's a little bit of a reset. And if the stock market does show some pressure, we're probably